Since late last year, the $1 exchange rate has increased sharply. This shift has been felt directly through higher costs for overseas services, including digital subscriptions, as well as direct purchases from abroad. When the won depreciates, import prices and global commodity prices tend to rise in tandem. These pressures feed through to consumer inflation. To examine the underlying implications of this rapid depreciation, KDI conducted a detailed analysis. Recent exchange rate movements reflect two distinct forces. First, the US dollar has strengthened globally, reflecting changes in US monetary policy and rising trade tensions. Second, domestic political and economic uncertainty has weighed on the won. Which of these factors has driven the recent surge? The evidence points primarily to dollar strength. The dollar index, which measures the dollar against major currencies, has moved increasingly in line with the won-dollar exchange rate. This indicates that recent fluctuations have been driven more by dollar appreciation than by a broad-based weakening of the won. This distinction is critical. The inflationary consequences differ materially depending on the underlying source of the exchange rate movement. When the exchange rate rises mainly due to dollar strength, import prices respond immediately, but the effect diminishes over time. When the depreciation reflects domestic factors, the won weakens against a broad set of currencies, not only against the dollar. As a result, the impact on import prices spreads more widely and intensifies gradually. How have these movements translated into consumer prices? A 1 percentage point increase in the exchange rate raises consumer prices by about 0.04 percentage points within the same quarter. Over a one-year horizon, however, price effects driven by domestic factors prove more persistent than those driven by dollar strength. In the first quarter of 2025, exchange rate movements contributed nearly 0.5 percentage points to inflation. While domestic factors remained broadly stable, this increase was driven largely by the strengthening of the dollar. What does this imply for the inflation outlook? If the exchange rate stabilizes at current levels, currency-related inflationary pressures are expected to ease. If the exchange rate rises to 1,500 won per dollar, and the increase is driven by dollar strength, inflation would rise by about 0.19 percentage points before gradually moderating. If domestic instability is the primary driver, the inflationary impact would be larger and more persistent, reaching up to 0.24 percentage points before easing.
올해 1분기 소비자 물가 상승률은 2.1%를 기록했습니다. 내수가 부진하다는 점을 고려하면 원달러 환율이 1,500원까지 오르더라도 소비자 물가 상승률은 최대 0.2%포인트 정도 추가 상승하는 데 그쳐 물가 안정 목표 2%를 크게 넘지 않을 것을 시사합니다.
By contrast, if the exchange rate declines to around 1,400 won, dollar-driven appreciation would reduce inflation by about 0.29 percentage points over time. If domestic recovery drives the decline, the disinflationary effect would be stronger, reaching up to 0.44 percentage points. Such effects could extend downward pressure on inflation into 2026. Ultimately, the inflationary impact depends on the source of the exchange rate movement. What are the implications for policy?
미 달러화 요인으로 환율이 상승하는 경우 그 영향이 단기에 그칠 수 있음을 감안해서 통화 정책을 수행할 필요가 있습니다. 하지만 국내 요인의 영향이 확대될 경우 물가 상승 압력은 더 지속적으로 파급될 수 있기 때문에 향후 환율 추이와 변동 배경을 면밀히 모니터링하면서 거시 정책을 운영하는 것이 바람직하겠습니다.
Rather than relying on reflexive responses to short-term volatility, policy should be calibrated to the magnitude and persistence of the inflationary effects.